All right, today we're going to talk about charitable contributions, and those are deductible, but there are lots and lots of rules. This can get very complex, and I'm going to try to keep it as simple as I possibly can. The first thing we want to look at is what is considered a charitable contribution and what is not. So the rule is that if your charitable giving needs to be given to a qualified charity. And so you can look on the IRS's website, I think it's called Select Check, to see if the charity that you're giving to is deductible. Most of the time your churches, any of your big charities like the Red Cross or United Way, things like that, those are all going to be charitable contributions, and those are those big public ones. But there are other things too. Your civil war veterans organization, so the VFW, civil defense organizations, things like your fraternal orders, those are all going to be charitable organizations. Things that are not charitable organizations are the homeless guy who's standing on the corner and you give money to him. Now, the Shriners who walk around with their red hats, the Shriners are a charitable organization. Other things that are not deductible: your time for any services that you give, not deductible. Giving blood, if you don't get a deduction for giving blood. Also, another rule is that the charitable organization needs to be organized within the U.S., so you can't give to a charity in another country. If you're giving in the U.S., that works, but if it's in another country, no. Now, if your church is sponsoring, say that your church is sponsoring another church family in Haiti, well, if you're giving to your church, then that's giving to your church, and then they can turn around and give it to Haiti with no problems for you. Another example is the Girl Scouts of Greater Atlanta, or Girl Scouts of Historic Georgia, or even Girl Scouts of the USA. All charitable organizations. However, Girl Scout Troop 1671 is not a charitable organization. So it has to be the bigger organization. You can't just give, or even a chapter of that, but you can't give to a small little, like, Girl Scout troop or Boy Scout troop or something like that. Political organizations, not charitable. Labor unions, they don't count. Anything that's international, I said before. Wagering losses for things like bingo at church, not deductible. Raffle tickets that you buy, no matter what that money's going for, not deductible. So there's a really good, at least there used to be, self-study problem. Yeah, it's on page 19 that has you go through a bunch of charities to see what's deductible and what's not. There will be some things in your homework as well. You also get to deduct 14 cents per mile. Now, this is a different amount than you were able to deduct for medical expenses. So you'll want to tab those pages, highlight those items, and look it up every time. Don't just rely on your memory. So if you drive around for charitable purposes, you need to keep track of your mileage, just like I explained in the medical expenses, and you get 14 cents per mile. And that would be added right in with all of those expenses. So gifts by cash or check is going to be included on line 16, including your mileage. What else do I need to say about that? I think that's about it. Donations for other than cash. Let's talk about that. So that's going to be line 17. So donations other than cash, you need a Form 8283, and I hadn't pulled that one up, but I'll do that in just a minute. So if you give any one gift of over $250, whether it's line 16 or 17, they say that you need to have a receipt for it. I say you should probably have a receipt for just about everything. Now, that Shriner standing on the corner, when you throw your loose change or whatever you've got into his hat, he's not going to give you a receipt. Or the March of Dimes, when they're ringing the bell at Christmas time, not going to give you a receipt. So what I do is I have a notepad in my car, and I write down where was I, what day is it, who did I give to, and how much did I give, and I stick that in my tax file. And I've never been audited, but if I was, I'm pretty sure that they would allow those little things because it's $5 here, $3 there, whatever I happen to have in my wallet. So those are allowed to be deductible. But if you give, if it ends up being large amounts, that's one place where people do get audited because that's a place where people cheat quite a lot. And I've got a little story to tell you about that. But first, I want to look at, would you believe, on page 18 at the top, it says a tax lawyer pleaded guilty to tax evasion in federal district court for substantially overstating his charitable contributions. He told an IRS agent that he put $500 in cash into the church collection basket each week. His pastor, however, said that the church never received more than $500 in currency at all of their weekly masses combined. I just thought that was so funny. He was just very much overstating. And I have a neighbor who did the same thing. He was claiming all kinds of deductions, I'm thinking, that weren't really deductions. And things like paying for activities for Girl Scouts. Anything that he paid to our troop, he deducted. And that they called me and asked me for receipts, and I said, well, do you mind telling me what this is for? And they told me they were being audited, and I said, well, you know that this wasn't deductible. That's okay, we just need a receipt for it. So they were just trying to justify exactly what those were. So I broke everything out and told exactly what it was. And I'm sure that they were penalized because it was very plain from my receipt that those things were not deductible. So, substantiation, there are a bunch of substantiation rules on page 18. You can read through those. Page 19 talks about car donations. Okay, so when you donate a car, the rules are a little bit different. You need to wait until the car is sold. So you cannot deduct the Blue Book value. And the deduction, unlike everything else, and I don't know if I've said this before, but your deductions are allowed in the year you spend the money. So that's really important to note. So if you donated a car in 2018 at the end of the year and you didn't receive a 1098-C until the middle of the year in 2019, it wouldn't be deductible until 2019. That's the year that you received that 1098-C. A 1098-C basically tells what they got, the fair market value of the car, and the fair market value is whatever they got for it, not the Blue Book, not anything else. It's whatever they got for it. So if they got $300 below what you thought they should get, then your deduction is going to be $300 below what you thought it was going to be. So you're not allowed to take that deduction until you get that 1098-C. And the would you believe here is quite funny too. It says tightening the rules for charitable donations of cars caused the dollar value of deductions to drop by 80% in 2005, the first year of the new rules. The dollar amount of charitable deductions for automobiles was apparently approximately $2.4 billion in 2004 and only $470 million in 2005. So that's a big area where there's a lot of cheating going on. So the last thing I want to talk about has to do with percentage limitations. And the main thing that I want you to know is that no one person or married, filing jointly people are allowed to deduct more than 50% of their AGI as charitable giving. So even if you gave away more than 50% of your income, you wouldn't be allowed a deduction for more than 50%. That limitation is changing in 2018. It's changing to 60%. But another thing, when you give items, I didn't really discuss that, did I? Items other than cash. That's when you give away household items. Most of the time, those items are worth less than what we paid for them, even if they still have a price tag on them. And the best way to account for that is to use what they call Deduct It or some other software. I use whatever comes with TurboTax, and it estimates the fair market value of all the items that I've donated based on what kind of condition they were in. If they were in fair condition, if they were in really good condition, or if they were in excellent condition. And believe it or not, those values are way higher than what I would have ever estimated them to be. So I highly recommend using that to calculate those things. Don't just guess. The trick is, though, you got to keep track of everything you donate. Some people take pictures of them. I just have a list. And I have a box where we dump the stuff, and when I'm getting ready to repack it to be donated, because it's usually just jumbled in a big pile, I refold things, put them in sections. So this was a boys medium, or this was a men's large, or whatever it happened to be, in categories. Like with dress clothes or suits. Boys outgrow those suits that they have to have for whatever reason, if it's their confirmation or whatever. So, I've donated a lot of stuff like that over the years. And dress shoes that they wore once. I'll usually donate those because somebody could probably use them. So if you keep track of all of that, you write it all down and what kind of condition it's in as you're packing it, then you've got a really good record of what you donated. But if you don't do that, then you're just guessing and you're probably cheating yourself. Either that or you're cheating the other way. I know that I end up cheating myself. But there are some really good examples here. The last thing that I want to talk about has to do with donating property that is worth more than it was when you bought it. So appreciated property that has appreciated in value. Just like a property that isn't worth as much, you get to take the fair market value. When you have long-term, what we call long-term capital gain property that has appreciated in value and you've had for more than a year, you get to take as a deduction the fair market value. So let's say that you bought some paintings back in 2005 for $500 each. You bought 2 of them. So you paid $1,000 for these 2 paintings. You donated them to the museum, the High Museum, and now they're worth $10,000 each. So you spent $2,000 and now they're worth $20,000. You get a $20,000 deduction. However, remember that can't exceed 50% or in the future 60% of your AGI. So that's kind of cool. However, if you didn't have that for a year, that appreciation in value goes away, and you can only deduct your cost if you held that for less than a year or a year or less. So your charitable contributions are limited to 50% of your AGI if you made them in cash. Those long-term capital gain contribution, other property. Let me back up. 50% of AGI. That's if you give to a public charity. If you give to one of the smaller private charities like the Fraternal Order of Police or the Moose Lodge or whatever it happens to be, those are limited to 30% of your AGI. And then your contributions of long-term capital of property to a 50% organization are limited to 30%. And your contributions of long-term capital gain property to a 50%, to a 30% organization is limited to 20% of your AGI. So lots of limitations, very complex. I'm not going to give you any problems like that. They're going to be cut and dry, and we probably won't deal with long-term capital gain. And if you do, it's one problem in the homework, but not that big of a deal. I hope I haven't confused you too much. If that last stuff that I talked about was confusing, just read page 17. If it doesn't make a lot of sense, just be aware that it exists, but that you don't understand it, and that's okay.